Right now, Opendoor Technologies Inc. is trading at exactly $7.52, surging upwards by 11.48% in today's intraday session. This is not just a standard green candle on a chart, it is a violent repricing event that is taking place at 12:08 p.m. Eastern Time on this Monday, November 24th, 2025. The volume pouring into this ticker is anomalous, suggesting that we are witnessing something far more structural than a simple retail pump or a reaction to a singular news headline. If you are watching the order book, you can see the bid-ask spread tightening as aggressive buyers step in to soak up liquidity, pushing the price toward the day's high of $7.58. This price action forces us to confront a reality that few analysts predicted just 6 months ago, when this stock was left for dead, trading at mere pennies. What you are seeing on your screen is the friction between a terrified short interest and a fundamentally altered corporate narrative that is catching the entire market off guard. The expectation for Opendoor has long been one of skepticism and eventual obsolescence. For years, the prevailing belief on Wall Street was that the iBuying model, where a company uses algorithms to buy homes directly from sellers, makes light repairs, and flips them, was fundamentally broken. The narrative was simple. When interest rates rise, holding costs destroy margins, and when housing prices drop, book values collapse. Investors looked at the failure of Zillow's iBuying division and assumed Opendoor would follow the same trajectory into the graveyard of zero interest rate phenomena. The expectation was that high mortgage rates throughout 2024 and early 2025 would suffocate the business, leading to a slow bleed into bankruptcy or a distressed asset sale. The reality, however, is slapping the market in the face today. Opendoor has not only survived the liquidity crisis that many predicted would kill it, but it has also executed one of the most aggressive strategic pivots in recent corporate history, transforming itself from a capital-intensive house flipper into a software and AI-centric platform. This divergence between the dead company walking expectation and the Opendoor 2.0 reality is what is fueling this 11% rally right now. To understand the magnitude of this move, you have to look at where we came from. Just a few months ago, in June 2025, Opendoor shares touched a 52-week low of 51 cents. At that price, the market was effectively pricing in bankruptcy. Today, trading at $7.52, the stock has delivered a staggering 14-fold return from those lows. This kind of volatility is rare in mid-cap equities and signals a complete capitulation of the bearish thesis. The catalyst driving today's specific price action is inextricably linked to the company's recent aggressive maneuvering against short sellers. The new CEO, Kaz Najarian, who took the helm recently, has openly declared war on those betting against the stock. This isn't just rhetoric, it is financial engineering weaponized against the bears. The distribution of tradable warrants, Series K, Series A, and Series Z earlier this month, was designed to create a complex headache for anyone holding a short position. When a company issues warrants as a dividend, short sellers are often forced to cover their positions or face the liability of delivering those warrants to the lender of the shares. What we are seeing today is likely the continued fallout from that corporate action, as shorts realize that the cost of maintaining their bearish bets has skyrocketed. Let us analyze the market mechanics driving this Monday afternoon rally. The volume we are seeing today is confirming the price action. When a stock gaps up and holds its gains into the lunch hour, as Opendoor is doing right now, it often indicates institutional accumulation rather than just day trader speculation. We know from recent filings that major quantitative funds like D.E. Shaw and Jane Street have taken significant stakes in the company. When entities of that size enter a trade, they do not just buy for a day, they build positions. Their presence creates a floor under the price, making it dangerous for short sellers to press their luck. The current price of $7.52 is testing key resistance levels. If the stock can close above the $7.50 mark today, it opens the door technically for a run toward the recent highs near $11. However, the volatility here is extreme. A stock that moves 11% in a morning can easily give it back in an afternoon if the broader market weakness creates a liquidity vacuum. You need to be watching the volume-weighted average price, or VWAP, very closely. As long as the price stays above the intraday VWAP, the bulls are in control. If it slips below, we could see a rapid flush as day traders lock in profits. The macro environment provides the backdrop for this drama. It's November 2025, and the conversation has shifted toward the Federal Reserve's December meeting. The market is currently pricing in a high probability of a rate cut, which acts as rocket fuel for interest rate-sensitive stocks like Opendoor. The 10-year Treasury yield has been volatile, but any stabilization or decline in yields directly improves the unit economics of the housing market. Lower rates mean more transaction volume, and for Opendoor, volume is everything. Even though they are pivoting to a lighter asset model, they still rely on people buying and selling homes. The deep freeze in the housing market that characterized 2023 and 2024 appears to be thawing, and the market is front-running that recovery. Investors are betting that 2026 will be the year of the housing turnover, and they are buying Opendoor as a high beta proxy for that thesis. If the housing market normalizes, Opendoor's revenue, which beat expectations in the third quarter coming in at $915 million, could expand rapidly. Now, we must discuss the short squeeze dynamic in detail, because it is the most critical factor for traders right now. Opendoor has a short interest that has hovered around 25% of its float. This is an incredibly crowded trade. When you have a quarter of the available shares sold short and the stock price starts rising on good volume, you create a feedback loop. Short sellers who sold at $3, $4, or $5 are now deep underwater. Their brokers are calling them, demanding more collateral. This forces them to buy back shares at the current market price of $7.52 to close out their losing positions. Their buying adds to the upward pressure, which forces more shorts to cover, creating a squeeze. The CEO's decision to issue warrants was a masterstroke in psychological warfare. By giving long-term shareholders the right to buy stock at $9, $13, and $17, he effectively signaled that management believes the stock is worth significantly more than the current price. This confidence is contagious. It forces the bears to ask themselves, do I really want to be short a stock where the CEO is actively trying to ruin my night? Speaking of the CEO, the leadership change is a central pillar of the bull case. Kaz Nagiatan bringing the founder mode mentality back to Opendoor, along with the return of co-founders Keith Rayballs and Eric Wu to the board, has completely changed the sentiment. The Opendoor 2.0 strategy is about moving away from being a capital-intensive balance sheet business into becoming a software and AI logistics layer for real estate. This is the exclusives marketplace they are building. Instead of buying a house, fixing it, and selling it, Opendoor wants to use its algorithms to connect buyers and sellers directly, taking a fee for facilitating the transaction without taking the risk of owning the asset. This approach is much more scalable and commands higher valuation multiples. The market loves software companies. It hates asset-heavy balance sheet companies. By reframing the narrative around AI and software, Opendoor is trying to get Wall Street to value it like a tech company rather than a real estate investment trust. The 11% move today suggests that this rebranding is starting to work. However, we need to be realistic about the fundamentals. Despite the hype in the stock price recovery, Opendoor is still losing money. In the third quarter, they reported a net loss of roughly $90 million. While this is an improvement, it is still a loss. The company is burning cash, although at a slower rate than before. The expectation of profitability has been pushed out to late 2026. This is the reality check that investors must keep in mind. You are buying a vision of the future, not a cash flow positive present. The stock is trading on momentum and the promise of a turnaround, not on current earnings power. If the housing market dips again, or if interest rates spike unexpectedly, Opendoor could easily retest its lows. The 1,400% gain from the lows of 51 cents implies a massive amount of optimism is now baked into the price. The easy money has been made. The next leg up requires actual execution on the business side. There is also a significant amount of retail sentiment driving this move. Opendoor has regained its status as a battleground stock on social media platforms. The discussions are heated, with bulls posting screenshots of their gains and bears warning of a rug pull. This retail engagement is powerful because it adds liquidity and volatility. It transforms the stock from a fundamental investment into a trading vehicle. When you see a stock move 11% on a Monday with no specific press release dropped that morning, it's often because the retail army has decided to squeeze the shorts. They smell blood in the water. The borrow fee, the cost to short the stock, has been fluctuating, and availability of shares to short has tightened. This creates a powder case situation where any positive spark can cause an explosion in price. I want to pause here and ask you to engage with this debate. Comment below. Do you think the CEO's tactic of issuing warrants to hurt short sellers is a brilliant strategic move or a distraction from the core business fundamentals? I want to see